What are your expectations in terms of what we're going to get out of the meeting?
Well, I think that the current agreement being discussed is really formalizing our base case as well as the rest of the market's consensus base case. And there's three components to that. One is they're likely to adjust the quotas to current production. Second, that's going to be contingent on better compliance from the producers that are cheating. That's primarily Iraq, Nigeria, Kazakhstan, and Russia. Russia and Iraq have already agreed or have moved their production to the quota levels in November. So I think we resolved that. Kazakhstan has maintenance going on. Now, the third is the extension of the cut that Brian was referring to. It's likely to go through the at least June of 2020 and further. Now, why is that important? I think, as Brian alluded to, you have a big surplus coming to this market during the second quarter, primarily driven by production that doesn't have much following behind it later on. Why? Because CapEx is down in non-OPEC ex-US. Those are legacy projects from 2014 when we had $100 oil. Second, CapEx in the U.S. shale patch is going down, so there's really nothing behind that. So if they can weather that storm in 2Q, they can get to the backside of it. Things look much better. Then they can talk about raising production after that. Now, what does this mean to prices? It can't go that high because this market is not that tight right now. So they need to force that rebalancing, and that drop in CapEx is what they want. They don't want that CapEx going back up again. Keep the CapEx low and declining, then they get free sailing on the back end.
And how about the demand side of the equation here? I mean, you look at what's going on with the U.S. and China and, back and forth every single day. And does that factor into the calculus at all?
When you look at the demand for commodities, fall in two buckets, what we call OPEC demand, that's tied to the new economy, and then there's CapEx demand that's tied to the old economy. CapEx demand is hurting, OPEC demand is going well, just like the global economy is. When we think about oil, it's primarily an OPEC commodity, jet fuel, gasoline, and so forth. As a result, the outlook for oil is much more positive than it is for something, let's say, like nickel or zinc.
As an S&P sector, oil's on the verge of going negative today for the decade.
Right.
Right? Since New Year's Eve of 2009. Yep. You think that's going to be different in 10 years?
I like to point out, you take Apple, it has a market cap bigger than the entire energy sector right now. Guess who was the first trillion-dollar company? It was PetroChina. These things go in cycle. Now, the odds of you getting back to that in the next 10 years, I think, are very, very difficult. I mean, we're talking way out there. But I think it illustrates a more important point in the commodity space. Capital to this sector, the old economy, is shut down right now. Why? Because I'd like to point out, the old economy, while it represents 35% of global GDP, 2/3 of corporate losses, 90% of the non-financial leverage in the system, 80% of global emissions. So it is overbuilt, over-levered, and over-polluted. And what we're seeing right now is the rebalancing that's really needed. So when we look at the decline in the ISM, the manufacturing declining, this is that rebalancing. I like to say, embrace the decline in manufacturing, don't fear it.
You mentioned trillion-dollar companies. There's another one I can think of that will be very soon, Saudi Aramco, which is going to be pricing, when is it pricing now, Leslie? Right
tomorrow.
Today, right?
Yeah.
How important sort of is that in the overall view of what the Saudis will have to do in terms of OPEC, and how important it is to have a public equity out there for them, even if it only trades in Saudi Arabia for now?
Well, I think it's a milestone in terms of their ability to diversify the economy and go after the Vision 2030. Now, in terms of the linking the two, it's more of an end of year issue, because what happens to this OPEC meeting and oil prices in the near term is not going to change investors' long-term view on commodities. I think the bigger issue is the point that you just brought up, which is the fact that old economy equities, whether if it is energy, metals, and mining, are out of favor. And I think that the one thing that's a big driver of that is not only the poor returns, but ESG factors are very important right now. In terms of thinking about the ESG factors, what's the easiest target to go after? Fossil fuels, metals, and mining. And when we think about ESG in 2020, in June of 2020, the UN PRI, which is Principal Responsible Investing, is going to suggest, it's not a law, but suggests that 50% of the signatures incorporate ESG strategies into their investing. That's going to impact $45 trillion of AUM. That is up from 22.5 this year, again to 45 trillion.
I'm glad you raised it. It's an enormous issue, one where you have to start covering more closely. I wonder, though, who's going to be the first fossil fuel company to do something dramatic in terms of responding to that?
Well, when you look at some of these producers out here, they're making large efforts. In fact, the Norway field that Brian was referring to, it has a 4% carbon emission leakage, 4% of what the other fields do. So you see the response out there.
But they're really good at that, aren't they?
Yeah, they're very good at it. They've made big strides. But I think that you're going to see that. I've had talks with miners suggesting green copper. Yeah, it's going to be expensive. But you are seeing an emphasis towards that. And I think the bigger issue there really is how long does it take to create that environment to absorb that capital? I think in the meantime, it's going to be a very difficult environment in 2020. Now, it's difficult for equities. We like the commodities. And the reason we like the commodities, dropping CapEx takes supply out of the market. Metals last year had the worst demand environment since 2008, 2009, yet inventories are normal because supply is dropping faster than demand.